Well, good afternoon and welcome to our High Rock weekly client webinar where we will talk about what we see happening in the global economy and in financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you likely know, if you're a regular listener, we invest our money in the exact same models as our clients. We think this is a very important highlight and defines our prudent and disciplined investing strategy. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to our clients, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson, and joining us on the call today are my partner and colleague, Paul Tepsich, the founder of High Rock. Our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson, has taken a short leave to have her first child, a big strapping 10-pound baby boy named Mason, but she will be on the call or on call to us for her expert advice should we need it for you. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit our homepage and click on the Introduction to High Rock Private Client button. While you are at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. As usual, let's start with a quick review of our themes for 2017. We think that our strategy of taking a tactical approach to investing is even more important this year because of the even greater levels of uncertainty imposed on financial markets by an onslaught of evolving factors. Inflation is a key determinant of central bank policy, and earlier in the year, expectations of increasing inflation pushed bond yields higher. But inflation has not lived up to those expectations, and now oil prices are falling. A little bit more on that in a moment. While most central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% in March and another 0.25% last week, and it is expected that they may raise them 2 more times this year. Is this a policy mistake? Stock prices and valuations are at 14-year highs, and only 5 stocks are driving the market. And while we wait on the Trump agenda to materialize, the UK election results have clouded the Brexit issue, and protectionist agendas continue to raise concerns. Tensions with North Korea, Russia, and the Middle East, as well as global cyber attacks and terrorist threats, all add to the blend of political uncertainty that we are currently facing. Well, correlations between stocks and bonds are changing, and with that, some of the historical safety of traditional buy and hold balanced portfolios in the US and in Canada. Paul, any comments on the correlations this week?
Nothing really to add today. We're actually seeing the correlation perform quite well. Stocks are lower, most certainly in Canada on the back of lower oil, but bonds have had a very strong day. So as you can see in the bottom part of that chart, the correlation is still, although it looks positive in green, it's still pretty highly negative, which is what we want to see for protection on our portfolio.
Thank you. And when we started our private client division over 2 years ago, we wanted to add a third dimension to the standard buy and hold balanced portfolio of equity and fixed income in an effort to add more value to client portfolios by reducing risk and further enhancing the risk-adjusted returns. In essence, this, along with our strict adherence to our code of conduct, defines what makes High Rock different and better. So we are patient, waiting for opportunities to buy assets for our portfolios, and it may be a reason why newer clients might still have a little more cash equivalent assets on hand, because building a solid portfolio takes time. No need to rush in and buy expensive assets if they are going to get cheaper. Well, each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. We take the allocation to the benchmark All Country World Index ETF and blend it with the Canadian Bond Index ETF. And that gives us a weighted return for comparison purposes. You may note that while the one-year blended benchmark net of fees has returned about 11% or just a little over, the two-year annualized return has only returned about 4%, which highlights the volatility over the last couple of years. Even the return over the last 3 years is well below the 5-year average. Now, our focus is on reducing that volatility in our portfolios in the short term in order to avoid big swings in return and capture more consistent long-term returns. As we look at a longer-term HIROC private client, the one-year total performance after fees is about 9%, a little behind the benchmark, but with about a 25% weight in a money market fund, this portfolio is significantly less exposed to expensive, risky assets like equities, which we believe are vulnerable to at least a 10% correction. But the longer-term 4.5-year performance is still well ahead of the benchmark, a sign that we have been successful in lowering short-term volatility, which does in fact enhance longer-term returns. At HIROC, we focus on the difference between the absolute returns and the risk-adjusted returns. The actual HIROC private client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60-40 comparative benchmark. This is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. And we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC, as we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. Inflation is one of our key themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, so too should inflation be going. And I've mentioned over the last couple of weeks that I attended a capital economics annual conference at the Fairmount Royal New York in Toronto. Capital Economics is one of the leading independent economic research companies in the world, and as I've continued to hammer home, the key word is independent. It means that they are not beholden to any client's interests as banks and investment firms might be. So there is no agenda or bias attached to their research, and this is good because they don't hold back. Only their reputation is at stake. And they see a pretty big correction in the Canadian housing market coming, which they suggest could be anywhere from 20 to 40% given the current dependence of Canada's economy on this sector. They think that the correction might potentially knock 1 to 2% off Canada's economic performance. They believe that this might bring the Bank of Canada to cut interest rates by 0.25%. And according to a capital economics report issued last week, Toronto's housing real estate boom is turning to bust after reaching a record high last quarter. Seasonally adjusted home sales have plummeted by 30% so far this quarter, while new listings activity has risen by a similar margin. Based on the slump in the home sales to new listings ratio, Toronto's large housing sector now appears poised for a correction in house prices before year end. But the Bank of Canada, on the other hand, is suggesting that the diversity of the Canadian economy is showing encouraging signs, which led them to infer that they may have to start raising rates sooner than later. We also showed last week, however, that the Bank of Canada's track record historically had been to err on the side of optimism. And now oil supply has sent oil prices lower. Paul, any updates for us on this?
Yeah, Scott, oil really has been hit really hard in here. We're down about $1, and we were down about $1.35 on the day just today. But so oil's trading around 43.25, having been as high as close to $55 a few months ago. And certainly one of my themes, I guess, on a micro basis is a lot of our Canadian E&P or exploration and producing companies looked pretty cheap. Their equities looked pretty cheap starting in January, February, all the way through the winter and into the spring, but they got cheaper and cheaper. So as I mentioned, I think last week on a risk basis. We do own some energy, but it's very, very measured. And we've been reticent to add to it, thankfully, because quite frankly, prices of these energy stocks have just gone down, even when oil is trading a bit higher. So we will continue with that. I think oil can hit, given it's breaking down. Not certainly you can't see it on that chart, but one of the other charts I look at, it seems to have broken down. I think it can hit minimum $40, but probably closer to 37. So I will not be adding any energy until we see those sort of numbers. That's it for now on oil. Natural gas as well, which we own a little bit of, has been hit down as well, not quite as hard, but we sure need to see some hot weather in North America to prop it up a little bit as well.
Excellent, thank you. Well, with the Bank of Canada statement, the Canadian dollar was up sharply last week, but the lower oil prices have moderated that up move over the last few days. So we'll keep an eye upon the Canadian dollar as well. Canadian bond yields have moved a little bit lower this week after a big jump last week. As we say and have been monitoring, all central banks have a mandate to maintain price stability. But other than the UK, inflation remains below target for most advanced economies. The U.S. Federal Reserve raised rates by 0.25% last week, and the Bank of England and Bank of Japan left their respective policies unchanged, although the Bank of England saw an increase in voting favoring tighter policy. But no immediate changes are expected for July, for July central bank policy decisions. And back to capital economics, they think the Fed will raise rates another couple of times more this year. And that is basically in line with the dot plot from the Fed Board of Governors on average. Although U.S. core consumer inflation remains well below target and U.S. growth forecasts continue to slip. The 2-year to 30-year U.S. bond differential has narrowed another 10 basis points over the course of the week since last Tuesday. It's down to 140 basis points or 1.4%. Remember, we monitor this, and as I suggested in my blog last Friday and have done so many times on this call, when the yield curve gets to flat, usually a recession is not far behind. Fed tightening and low long-term bond yields, if they remain that way, will soon flatten the yield curve. So we need to be very careful and watch this closely. And the yield curve in Canada is collapsing. Bond traders are showing the Bank of Canada what they think of the latest Bank of Canada suggestions on interest rates. So again, something else we have to be very cognizant of. And we're also paying close attention to the global debt situation and borrowers' ability to service that debt. As I show you each week, global debt levels are growing, and that is at an approximate rate of about 5% per year. But global economic growth is only expected to show about a 3% per year increase. So that's also something that we are concerned about here. As we know, Canadian household debt is at record levels, and while the ability to service that debt has improved, household indebtedness is continuing to rise, hitting 174% in the first quarter of 2017, which means Canadian households owe about $174 for every $100 in disposable income. Now, a new report from the Parliamentary Budget Office expects household indebtedness to hit 180% by the end of 2018. U.S. household debt has jumped to new records on the back of student and auto loans, although U.S. households may have a little easier time servicing their debts, but the costs of borrowing are rising. And this is no surprise, we think stocks are expensive. And as I mentioned every week pretty much, the 12-month forward-looking price to earnings ratio is at almost high 17.7 times, which includes expectations of about 10% earnings growth for 2017. Now, the 10-year average is at 14 times. So just to get back to the average, earnings would have to grow by an additional 20% in the next 12 months above the already expected 10% growth. This is not likely to happen, so we are uncomfortable with the current valuations. If the U.S. economy can't grow more than 2%, it is hard to see earnings achieving even the 10% that is expected. But stock prices have been outperforming economic growth, and another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were way back at the time of the dot-com bubble. And as I mentioned earlier, 5 stocks, which only represent about 13% of the S&P 500, Apple, Google, Amazon, Facebook, and Microsoft, have been responsible for about 40% of the performance so far this year, which means that investors are underestimating the risks inherent in these businesses. But we're not at High Rock. And high equity prices equate to high risk, so we continue to remain patient. Well, let's take a look at the geopolitical front and what's happening most recently. The Trump administration is trying to move its agenda forward. The Senate Republican leaders have set a timeline to vote next week on legislation to repeal large chunks of the Affordable Care Act, otherwise as known as Obamacare, even though they don't yet appear to have secured enough support to pass it. Treasury Secretary Steve Mnuchin said today he isn't concerned about U.S. tax receipts coming in lower than expected in recent months. In an interview on Bloomberg TV, he said the Treasury could meet its obligations through September if Congress doesn't raise the debt limit before leaving for a 5-week summer recess. And House Speaker Paul Ryan expressed continued confidence that Republicans can fix this nation's tax code once and for all, despite a long list of hurdles in front of them. And U.S. Commerce Secretary Wilbur Ross said the best window to complete the renegotiation of NAFTA is by early January, well before Mexico's general elections and U.S. congressional elections in 2018. President Trump doesn't seem to be concerned. And over in the UK and the Euro area, Bank of England Governor Mark Carney ended more than a month of silence with a major speech that pushed back against rate hawks in the Bank of England and re-emphasized his concerns about the impact of Brexit on the UK economy, highlighting the risks to consumer spending, business investment, the current account deficit, and financial services. He indicated he's in no rush to raise interest rates, saying he wants to see how the economy responds to the reality of Brexit negotiations. So here at High Rock, we want to continue to get portfolio growth, but we are also not comfortable taking equity market risk with the current situation concerning stock prices. The U.S. economic cycle is in its late stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. We and our clients have worked too hard for our money, and we want to make sure that we invest it prudently. We are stewards of wealth. We are not gamblers. Paul, anything you want to add today?
Actually, I probably added most of it when I commented on the price of oil. So I have opened up a new file. It is an oil company, an investment-grade oil company, but I don't think we're going to be buying it. And I've only been working on it for about 2 days, and I may just stop there. I think this thing is in trouble. I think there are other companies out there that might be better positioned. So, and I've got one in mind. But we've done nothing across the past week. We did add some securities, non-energy related, to some newer clients that did not own them. But away from that, and for the rest of our older, more existing clients, we have not added any securities the past week. That's
Excellent. It. All right. Thanks so much for your contributions. I know that people enjoy getting a little update and insight into our thoughts and your thoughts and anything that we're up to. Okay, well, as always, we want to thank you for taking time out of your busy schedules to tune in. If you have any questions or concerns, please certainly feel free to email them to us. We'd certainly love to get feedback on the presentation that we do each week and whether or not you think it's worthwhile. We do notice that we've had a few more viewers of late, which is excellent. But if you have anything that you'd like to see us discuss or not discuss, please feel free to let us know. We will be back next week with our next update next Tuesday. I will announce that on July the 4th, being a U.S. holiday, we probably will not have a webinar, so you can plan accordingly. But we will certainly be here next week. Until next week, then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we do want to wish you all a great rest of the week.
Oh, and Scott, just before you sign off, you're leaving tomorrow morning very early for Vancouver to see some clients and prospective clients, correct?
Absolutely. Looking very much forward to it.
When do you fly out and when do you fly back?
I will be flying out as you said, very early tomorrow morning. I should arrive in Vancouver around noon. I should be back. I will be leaving Friday morning, so I've got. I'll be there per half of tomorrow and then all day Thursday. I have a few open time slots if there is anybody in Vancouver listening who would like to sit down. So yeah, please let me know if you have any interest in having a chat. All right. We shall again talk to you all next week.